This is the voiceover presentation for Chapter 5 in the Rothermel textbook on shared value and competitive advantage. The second step in the strategic management process is setting up goals and objectives. They act as targets for strategic performance. Chapter 5 provides two perspectives on measuring performance: traditional measures of success such as stock prices and economic value added, as well as shared value. In either case, the measures of performance should be aligned with the firm's mission, vision, and values. The purpose of this chapter is to examine a firm's articulation of its performance metrics. We first need to establish the foundation for setting goals and objectives. To do so, I'll review two slides from chapters 1 and 2. This slide from chapter 1's discussion of stakeholders discuss the context in which strategic decisions are made. For purposes of setting goals and objectives, the bottom two boxes are the most pertinent. The personal values of the key stakeholders ask decision makers to consider what the most important stakeholders, typically the owners of a firm's capital, want from the firm. The box on societal considerations asks decision makers to consider what role the firm will play in its communities, as influenced by what society expects from its businesses and the boundaries in the form of laws and regulations that it sets on them. The strategic management process describes the steps involved in making strategic decisions, the personal values of key stakeholders, and how the firm chooses to interact with society will be reflected in the firm's goals and objectives. The connection starts with clearly describing the nature of the firm through its mission, vision, and purpose that establishes the boundaries on what it does and what it does not do. Then firms translate that business definition into observable metrics by establishing measurable goals and objectives. Setting goals and objectives, therefore, serves as the focal point for formulating and implementing strategies. Now we clarify the relationship between the mission and vision, the goals and objectives, and the performance metrics. The mission and vision, perhaps presented as a core purpose, are often esoteric in how they are presented, like this one from Coca-Cola. Judging a company's progress in achieving those core purposes would be impossible because they're so lofty. To monitor progress and judge performance, firms set precise goals and objectives. Consider goals to be broad and overarching, while objectives are the steps involved in supporting those goals. There should be a clear connection between each goal and the firm's mission. If present, that connection means that achieving the goal is within the bounds of the firm's business definition, has a clear purpose within the firm's overall mandates, and will contribute to the firm's competitive performance. Setting goals must be done carefully. First, selecting goals highlights opportunity costs. Every firm has more goals that it would like to achieve than it has resources to pursue. So the goals that a firm does select, while others left unattended or unfunded, indicates where the firm is going to allocate its resources. In doing so, a firm makes clear what it will do, and by omission, what it won't do, as required by the business description step in the strategic management process. And it's always better if the goals and objectives are clearly and directly measurable. Firms often use scoreboards or dashboards as displays of key metrics, and these gauges are helpful in keeping everyone on the same page. However, some goals and objectives are impossible or very difficult to measure, such as employee satisfaction. Sometimes latent measures, rather than direct measures, will be all that's available. Further, measures can have unintended consequences. For instance, overburdensome objectives on time, such as time to serve a customer or time to take care of a patient, can lead employees to take shortcuts or avoid interactions that they expect would lead to poorer time scores, or creating incentive systems that offer outsized rewards for achieving particular targets can lead to unethical behaviors by employees that are really close to making that target but just short. That is, too much emphasis or pressure on a particular measure can create problems in other areas. In all, a firm's goals and objectives should naturally flow from its mission and vision and support the overall performance of the firm without creating unintended consequences. Generally, strategic goals are almost always relative to some reference point. Only certain things can be measured as an absolute target, such as launching a new product by a specified date or bringing a new manufacturing facility online under a certain cost. Those would be absolutes. Most goals are measured in degrees of change or against some benchmark. For instance, say a software firm earns $12 million in a given year. Will this be celebrated by shareholders? It depends. If last year's earnings were $14 million, they will not. If last year's earnings were $10 million, shareholders will be very happy. And then there can be multiple reference points. Even if earnings went from 10 to 12, a 20% increase, shareholders might be quite a bit less happy if a firm's primary competitor earned 30% growth in the same time period. All of this is to say that there are many, many ways to judge performance. Let's walk through the options that key stakeholders have when setting goals and objectives. To begin, a fundamental goal of any organization is to generate enough revenues or cash to cover expenses. If it does not meet this basic standard, it will go out of business when it uses up its equity position, making any other goal moot. If you don't recall the relationship between profitability and an income statement, the flow of dollars through a statement of cash flows, and the shareholder equity position on a balance sheet, or ratios like return on investment or a current ratio, please review them. As a starting point, there are brief but helpful videos on YouTube. Once a company is confident in its solvency, it can pursue a range of business outcomes. Generalizing, let's break them down into financial and operating uses and near and long-term uses. In the near term, earnings can be used to make distributions to a firm's capital providers, either in the form of personal income to owners or in dividends paid to shareholders. Alternatively, money can be directed to improving a firm's current operations, such as maintaining its equipment or ensuring proper compensation to keep key employees. In the longer term, earnings could be used to improve a firm's capital structure, such as paying off debt or buying back stock. In operational terms, a firm can invest in its own future by hiring additional people, buying new equipment or technologies, developing new products or services, or entering new markets. Importantly, notice that all of these elements are opportunity costs relative to one another. If $1 of earnings is paid out in dividends, it can't be used to pay down long-term debt. Paying down long-term debt means there are fewer dollars available for paying bonuses or investing in new machines or R&D projects. But every one of these uses of earnings could possibly have a positive effect on a firm's health. The trick becomes balancing out the uses of earnings and directing investments into the elements that will have the greatest long-term return for the firm. And this is where the different ways of measuring performance discussed in the chapter come in. The text discusses 3 different performance mechanisms, or different ways that a firm can measure performance relative to goals and objectives. The 3 are accounting metrics, shareholder value, and economic value creation. The very first place that most analysts start when looking at a company's performance is its accounting data. The most complete set of financial reports from a public company is published in a Form 10-K, a report required annually from every publicly traded firm by the Securities and Exchange Commission. The best ways to analyze accounting data is through ratio analyses and trend analyses, both of which involve comparing a given number to other numbers, either of different kinds or in different time periods. While these numbers provide lots of information, the text does a good job discussing why accounting data can be misleading. Refer to the chapter for a review of these limitations. Despite imperfections, accounting data can tell us if a company is on the right track or not. Shareholder value creation, as discussed in the chapter, focuses on how markets value a company. While accounting data is a historical record, markets value firms based on their future prospects. For example, Uber reported its first ever operating profit in the second quarter of 2023. It had lost money every quarter since its founding in 2009, but its market capitalization during those years was as high as just over $110 billion, reached in 2021. The point is that even though Uber was reporting losses in its accounting data, investors still loved owning Uber stock. Why is that? Because the stock market values a firm more on its prospects than on its results. People buy a stock because they think the company's value will go up in the future and get out of a stock when they believe it will underperform. The market capitalization, therefore, becomes a telling sign from the market to a firm's top managers. If the market feels the managers are making the right decisions, it will support the firm's stock price. If the market thinks the company is messing up, the stock price will go down. This is the reason that executives worry about their stock prices. Last, economic value creation compares the total cost to produce a product or service with the price that the product or service can command from customers. Actually, economic value creation can act as a measure of performance relative to both customers and to competitors. In this graphic, economic value creation is relative to customer expectations. Here, the author includes both the firm's profits, or the revenue generated above costs, and the customer surplus, or the benefits of buying a product perceived by the customer that are in excess of the item's price. This formulation can generate lots of conversation around pricing. Notice that the economic value created would not change if the firm increased its prices. That would increase its profits, and the customer surplus would just shrink. Alternatively, economic value creation can be relative to customers. In this graphic, Firm B is outperforming Firm A in terms of revenue creation, even though their cost structures are the same, making Firm B the winner. In another way of looking at it, focusing instead on cost structures, this graphic indicates Firm C is outperforming Firm D due to its lower cost structure, even as both have equal pricing. Along with these financial-based views of performance, firms can also choose their level of investment into community and social development. This is related to stakeholder capitalism, shared value, and the triple bottom line as described in the text. There are several established frameworks for viewing performance measures that are not purely financial. I'll go through three. First, the United Nations Global Compact encourages businesses to align strategies and operations with universal principles on human rights, labor, environment, and anti-corruption, and take actions that advance societal goals. It promotes these 10 principles as well as 17 Sustainable Development Goals, which I encourage you to look up. Second, many firms sponsor charitable giving through corporate foundations and structured volunteer activities. Target Stores, for example, has for years directed 5% of its profits to its foundation for community support initiatives. Home Depot has a Team Depot website where its employees can sign up for volunteer opportunities. Charitable and philanthropic donations, in the form of both money and time, have multiple performance ramifications. In terms of performance, firms which dedicate resources to these efforts believe their costs are offset by the goodwill created in their employee ranks and the reputational boost that these firms earn through their contributions to their communities. Last, investors have signaled support for companies that pursue shared value through investing based on ESG standards, directing capital to firms that rank high on environmentalism, social impact, and effective governance. While ESG elements as an investment criteria can be controversial, firms have paid attention to these initiatives just because of the power these investors have. To summarize, for this chapter, the key takeaway starts with a slide on strategic context. The firm's key stakeholders have the power to determine the firm's goals. While most of those goals will be financial returns, they can also choose other goals, such as in community investments. This certainly comes into play if the key stakeholders view their firm as playing a role in society beyond just being a good investment for capital providers and a good place to work for employees. So setting goals and objectives is a key step in the strategic management process, serving as a translation of the firm's mission and vision into observable targets, which then provide guidance on the formulation and implementation of the firm's strategies. And this concludes the presentation on Chapter 5.